Hello friends, today's topic is charge of tax and rate of tax. Charge of tax has been defined under section 10 and it's the charging section of the overall heads of income, and the rate of tax applicable to the individual's firm, company on which they would be liable to tax. So the charge of tax. So in the earlier topic we have studied that what is the charging section. So charging section, there is already under the various heads of income, and the prime charging section is the section 4 of the Income Tax Act, which through this section the liability of the SSC is determined. Okay, so section 4 on the screen, you can see section 4 of the Income Tax Act is the charging section. The tax liability of the person comes from this section. It provides that there are 4 subclauses to it. Tax shall be charged at the rates prescribed for the year by the Annual Finance Act. Then the charge is on every person specified under section 231. So we have studied under the definition of person. So there are 7 categories and the charge is on the person. And the first point, tax shall be charged at the rates prescribed under the Annual Finance Act. The rates are prescribed in the Annual Finance Act as well as under the Income Tax Act. So clause 1 covers the rates as per the Finance Act, and clause 2 covers that the charge is on every person. Third point is tax is chargeable on the total income earned during the previous year. So while studying the concept of previous year and assessment year, we have learned that the income of the previous year is assessed to tax in the assessment year. So the charge of tax is on the income earned during the previous year and not the assessment year. Tax, and the fourth point, tax shall be levied in accordance with and subject to various provisions contained in the Act. Yes, so the provisions contained in the Act, there might be a proviso, there might be an exception, or there might be exemptions as per section 10, in which as per section 2 it will be termed as an income, but it might be possibility that the same income is exempted as per section 10. So the fourth clause says tax shall be levied in accordance with and subject to various provisions contained in the Act. So it may be possible that income is totally exempt, and it may be possible that it is partly exempt. So this was the charging section, which is section 4. Next is rates of tax. So first we will consider individuals' rate of tax. Individuals are taxable as per the slab rates. The slab rates applicable is for the resident individuals, AOP, BOI, body of individuals, associate of persons, Hindu undivided family, and artificial judicial person. So this is the slab rate is applicable to these persons. On the screen you can see there is a slab rate in which up to 2,50,000 nil rate is charged. From 2,50,000 to 5,50,000 income, 5% rate is charged. From 5 to 10, 20% is charged, and from about 10 lakhs 30% is charged. So this is the slab rates which is applicable to individuals, HUF, AOP, BOI, and artificial judicial person. We will conclude this with a way of example. Example is Mr. A has total income of 13 lakhs comprising of his salary income and interest on fixed deposit. Compute his tax liability. So in his case his total income is 10 lakhs. So 10 lakhs is exceeding 13 lakhs is exceeding 10 lakhs. So his income should be computed as, first is 13 minus 10 on 3 lakhs, 30% would be charged. Then for this too, it would be like on 2,50,000, 5% is charged, and on 5 lakh, that is 10 lakh minus 5 lakh, 20% is charged. So there is a progressive rate of taxation in which 3 lakh is charged as 30, then 5 lakh is charged at 20%, and 2.5 2.5 is charged at 10%. Total tax would be determined accordingly over here. So the 13 lakh would be charged, 3 lakh is 30%, 5 lakh is 20%, and 2.5 is 10%, which has been derived based on the slab rate which has been determined over here. So, and 2 lakh 50 would be exempted as well. So out of 13 lakh, if I see 13 lakh minus 10, 3 is 30%. Then 2 lakh 50 is exempted in his case. So this 10 lakh component 2.5 we charge nothing. Then thereafter 2.5 is 5% and 5 lakh is 20%. So effectively 7.5 only is charged to tax. Out of this 2.5 is 5% and 5 lakh is 20%, and remaining 3 lakhs which is tax at 30%. So this is progressive rate of taxation applicable to the person mentioned over here: individuals, HUF, AOP, BOI, and artificial judicial person which are resident in India. For senior citizens, they have a benefit in the slab rate taxation, in which normal individuals which are resident in India, or you can say which are non-resident as well. So to add on, the slab rate which we have discussed earlier is applicable to resident individuals below the age of 60 years, and it is applicable to all the non-residents. Now the resident individuals whose age is more than 60 years or more, then the slab rate will start from 3 lakhs instead of 2 lakh 50. So over here it's instead of 3 lakh, it's instead of 2.5 lakhs, it's 3 lakhs, and the tax rate is nil. Thereafter from 5 to 3 is 5%, and 10 to 5 it's 20% over here. So it remains same as individual, or it remains same, the example remains same as we have discussed earlier. The only change is from 2.5 the benefit is shifted to 3 lakhs, which is applicable to senior citizens at the age of 60 years or more, and they should be resident individual in these cases. And for super senior citizens, for which who are also resident and whose age is 80 years or more, their slab rate will start from 5 lakh and not 2.5 lakh or not 3 lakhs. So there are 3 slab rates. For resident individuals with age 80 years or more, the slab rate would start from 5 lakh, and then from 10 to 5 it's 20%, and above 10 it's 30%. It remains the same. Then for resident individuals, senior citizen whose age is more than 60 years or more, the slab rate will be starting from 3 lakhs, and the residual category, you can say, is the slab rate starts from 2.5 to lakh 50,000. Now in the case of senior citizen and super senior citizen, there is a clarification issued, in which there is a circular issued by CBDT, in which case the date of birth if of a senior citizen and super senior citizen is 1st of April of the relevant year, it will be termed that they have attained the age on 31st March of the preceding year itself, meaning in our case the financial year is 1920, and the date of birth of the senior citizen and the super senior citizen comes at 1st of April 2020. So in that case, their date of birth will be counted as the preceding day, that would be 31st of March 2020, and they will attain the age of 60 years or more or 80 years or more from 31st March, and for the financial year 1920 they will be treated as super senior citizen or senior citizen. On the screen, clarification regarding attaining prescribed age of 68 years on 31st March itself. So circular number 28 2016, 27th of July 2016. This is the question, whether it should be date of birth should be 31st March or 1st of April. In this case, the Supreme Court in the case of Prabhu Dayal Sheshma versus State of Rajasthan 1986 held that in the absence of any express provision, it is well settled that any specified age in law is to be computed as having been attained on the day preceding the anniversary of the birthday. So in this case, it would be 31st March. CBDT by this circular clarified that a person born on 1st of April would be considered to have attained a particular age on 31st March, the day preceding the anniversary of his birthday. In particular, these are important. In particular, the question of attainment of age of eligibility for being considered a senior, very senior citizen would be decided on the basis of above criteria. So this criteria is applicable for senior and very senior citizen. Now rates, we have discussed for the rates of tax applicable to individuals, AOP, BOI, artificial judicial person, and now the rates of tax applicable to firm, LLP and local authority is 30%, a standard rate. Then for cooperative society there is a slab rate in which income which does not exceed 10,000 is 10%. There is no nil rate as such. Total income between 10 to 20 of a cooperative society is taxed at 1,000, which is 10% of 10,000 plus 20%, and then about 20%, about 20,000 is nothing but 3,000 plus 30% for cooperative society. Rates applicable for a company, the different rates for domestic company and the foreign company. For domestic company, you can say there is a bifurcation for a manufacturing company and other than a manufacturing company. So for a domestic company other than a manufacturing company, if a total turnover or gross receipt in the previous year 17-18 is less than or equal to 400 crore, then it would be 25%. Else in any other case it is a standard rate of 30%. So a concession, so generally companies are taxed at 30% if the turnover in financial year 17-18 is less than 400 crore, then the rate of tax would be 25%. And in this case, minimum alternate tax is applicable to the company, in which case the concept is as per the income tax provision and the tax as per MAT or minimum alternate tax is compared, and if the tax as per income tax provision is less than the tax payable as per MAT provision, then the ultimate tax liability will be determined as per MAT provisions. So in this case, the MAT applicability, minimum alternate tax, is applicable to these entities in both the cases, and the rate of tax is 15%. And in the case of domestic company, which is manufacturing company, set up and registered on or after 1st of October 2019 and commences manufacture on or before 31st March of 2023. So the business is set up on or after 1st of October 2019 and the manufacture is commenced on any date before 31st of March 2023. If this condition is satisfied, then there is an option of exercising a beneficial rate under section 115 BAB, which is 15% of total income. So in sharp contrast to 30% over here, it will be taxed at a beneficial rate of 15% for a domestic manufacturing company which is set up after 1st of October and production has been commenced before 31st of March 2023. And in another beneficial rate, a domestic company exercising option under 115 BAA, 22% of the total income would be applicable. So 15%, 22%, 25% and 30%, there are different rates applicable to different companies over here, and in both these cases 115 BAB and 115 BAE, MAT won't be applicable. In case of a foreign company which is not a domestic company, the rate of tax is 40%, straightforward. The rate is 40%. It would be 50% if the agreement for royalty and fees for technical services is entered on or before, you can say, 1976. Then the rate was 50%. So generally for foreign companies there's a standard rate applicable, which is 40%. Now here we have discussed the rates which are applicable as per the Finance Act. This elaborates the rates which are applicable to firm, to companies. Now there are certain rates which are applicable as per the provisions of the Income Tax Act, and they are inbuilt in the provisions of the act. They need not be mentioned in the, and they are not mentioned in the Annual Finance Act. So what are these provisions? First is section 112, which states the taxability of long-term capital gains, and the rate in that case is 20%, which is mentioned in the act. Then 112A, which states that long-term capital gains from equity shares or equity oriented fund or business trust would be subject to tax at 10% if long-term capital gains is exceeding 1 lakh. So on the screen, long-term capital gains on transfer of equity share, unit of equity oriented fund and unit of business trust, 10% on long-term capital gains which is more than 1 lakh. Condition for availing the benefit: there is condition in which STT should be paid on both purchase and sale of shares in the case of equity shares, and STT should be paid on the transfer of the shares in the case of unit of equity oriented fund and unit of business trust. As you can see, condition for STT in the case of capital asset, equity shares, both are covered on acquisition and transfer, equity oriented and business trust at the time of transfer, and long-term capital gains up to 1 lakh is exempt and above 1 lakh is taxable entirely at 10%. Then there is short-term capital gains on transfer of equity share or equity oriented fund under section 111A, which is taxed at 15%. Then, and units of business trust is also covered over here. The condition therein is transaction of sale should be entered on or after October 2004, and such transaction should be STT paid. Section 115BB, which includes winning from lotteries, crossroad puzzles, races including horse race, card games and gambling, in which case the rate of tax is 30%. 115BBDA, income by way of dividend exceeding 10 lakhs in aggregate. So it will be taxable at 10%. We will be discussing this in detail in the note 1. Then 115BBE, in which we have studied earlier that undisclosed sources of income, cash credits, unexplained expenditure. In that cases, the rate of tax is 60%, which is mentioned under the provisions of the act, which is mentioned under section 115BBE. Now note 1. Section 115BBDA, when it is taxable as dividend income if the income is exceeding 10 lakhs and it is applicable to the resident individuals. So BBDA provides that any income by way of aggregate dividend in excess of 10 lakhs shall be chargeable in the hands of a person other than a domestic company, other than a fund, institution or trust or university or other education institution or hospital or medical institution. It is not taxable in their hands. A trust institution registered under section 12AA. In these persons it is not taxable, else it is taxable in the resident person who is resident in India at the rate of 10% under section 115BBDA. Further, the taxation of dividend income in excess of 10 lakhs shall be on gross basis. On gross basis, you will not be eligible for any deduction of the expenditure. You will not be eligible for any exemptions on this dividend income. So, it will be taxable on gross basis. And 115BBE, again, it is the high rate of tax. The high rate of tax is charged to control laundering of unaccounted money, undisclosed money, by availing the benefit of basic exemption limit. So what a person can do is they can use the unaccounted money and show it in the hands of a relative okay, and in which who do not have any source of income, and that's the only source of income that they have, that is the undisclosed income, and they can take the benefit of slab benefit, and accordingly the incidence of tax or the rate of tax can be reduced. To check that, to rectify that mischief, to rectify that defect, this remedy has been sorted, in which the tax rate would be 60%. In this cases also it will be taxed at gross basis, in which there is no basic exemption, no allowance or expenditure or set off of loss shall be allowed for these undisclosed sources of income. To summarize what we have read in this section is, first we have read the charging section, which is charging section 4. There are 4 subclauses to it, which states that first clause is the rates of tax which has been determined, which has been mentioned in the annual finance act. Then there is charge is on every percent, charge is for the previous year and not the assessment year, and the charge shall be levied as per the various provisions of the act. Then we have studied the rate of tax which is applicable to individuals. There are 3 slab rates, which is start from 2,50,000 for the residual category, then starts from 3 lakh for individual resident with age 60 years or more, then starts from 5 lakh for resident individual for age whose age is 80 years or more. These are the slab rates. Then we have read the circular, in which the date of birth, if is 1st of April for senior citizen, for super senior citizen it will be counted as 31st March. Accordingly, for financial year 1920, if the date of birth is 1st of April 2020, for financial year 1920 they will be assumed to be having the date of birth in 1920, and they may qualify as senior citizen or super senior citizen. Then rate of tax for firm, LLP, local authorities 30%. For companies, for cooperative society there is again a slab rate 10,000, 10 to 20, and more than 20 it's 30% plus 3,000. Then for companies there are varied rate of tax depending upon the beneficial rate, depending upon whether it's a domestic manufacturing company or not. Then it could be 15%, 22%, 25%, and 30%. Then foreign company is taxed at 40%. Then this where the rates are specified as per Finance Act, and there are certain rates which are specified as per the provisions of the act. First is 112, 112A, 111A, long-term capital gains, short-term capital gains. There are varied rates for it. And then there is a dividend income which is taxed at 10%, winning from lotteries, crossroad puzzles is taxed at 30%, and there is a 60% rate of tax for undisclosed sources of income. Thank you.